Recently, markets entered a correction for the first time this year. What are corrections? How common are they as an investor? I've got those details and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. If you're a daily watcher of our videos here at the Wise Money Show, thank you. By the way, thank you. This is lagging a little bit because what I want to talk about is at the close of business on Friday, October 27th, the stock market, U.S. stock market, most indices, entered correction territory, entered a stock market correction at the close of business. The S&P 500 down about 10%. And so this is the first correction that we've seen in 2023, but it's the fourth correction that we've seen over the past 2 years. And take a look at this chart here. It's been a bumpy ride, and you guys know this, and this isn't even telling the full story, but you can see in red here the corrections that we've seen over the past 2 years, and we're just about 2 years removed from hitting an all-time high in the stock market. We've just been bouncing through. I've had previously, I was telling a client these are sort of the consolidation phase or the pointless ups and downs in the markets, what we're seeing right here, a sideways market. But you can see down about 10% as of a couple weeks ago, the end of near the end of October. That's the first correction that we've seen this year, but we saw 3 of them in 2022, a very unusual and challenging year in the market. So begs the question, how frequent or how unusual is a stock market correction? Well, just get some of the jargon out of the way here. Stock market correction is defined as a decline from a high point. Doesn't need to be at the beginning of a year, or beginning of a quarter, beginning of a month, just from a high point to a low point of at least 10%. So a correction is a 10% decline from a high point to a low point, often mixed somewhere within the year sometime. But contrast that correction, compare that to a bear market. A bear market is a same thing, but from a high point to a low point, a decline of 20% or more. Oftentimes, bear markets, those 20% declines, are connected to recessions. Not always. We did see a 20% decline or more. We saw a bear market, a couple of these corrections during 2022. All of that equaled a decline of over 20%, as it reached about 26% at its low point. So we were at bear market territory, and then we've expanded. The markets have grown out and grew, had a recovery, not all the way back up, but had a recovery. So we're out of that bear market. Now we've entered this fourth correction. So is that unusual? Is that unusual? No. This is extremely common. While it's never fun, it's not fun to watch the markets go down or see your investments or your statements decline. This is a feature, not a bug. It's a feature of investing, not a flaw. If you take a look here at this chart, this is about as simple as I can make it. Now my brain thinks in spreadsheets, so sorry about that if yours doesn't, but you can see that a 10% intra-year decline, so from some high point to a low point, a 10% decline in the S&P 500 it happens about 63% of all years. Or said differently, and this is smoothing a lot of things out, going back, several decades here, about 1.6 years. I often say, okay, about a year and a half. About every year and a half, we'll see a correction. Compare that to a 20% decline, that bear market, that happens only 26% of all years, or every 4 years approximately. And I usually say, yeah, you're going to experience, just as a normal long-term investor, you're going to see a bear market, likely even a recession, every 4 to 5 years, something like that. But these corrections, these 10% declines, are more common. And again, not enjoyable, not fun. And a 10% decline, if you've got $1 million invested and you're growth oriented and that's in stocks, you're going to see a decline of about $100,000 every year and a half or so. That's a meaningful amount. And yet, despite these averages of how frequently these occur, the stock market handedly, held over the long term, has provided an annualized return of approximately 10% per year over the long term. But it's, again, not without its short-term bumps and ups and downs. Now, because of everything that's been going on in the economy, and because of how aggressively the Fed, how awful the Fed missed the inflation call, and then how aggressive they needed to be, there's been a lot of people that have been bracing themselves or even calling for a stock market crash. Well, it's very possible. It's very possible that this correction does get worse from here, leads to a bear market and potentially even worse. We'll see. Only time will tell. I'm just pointing out here that historically, that's not a foregone conclusion. That doesn't, corrections are fairly common, and not all of them lead to bear markets or even crashes. I would say a crash is a decline of 40% or more, and you can see just how rare that is. Once every 16 years, a 50% decline, odds are, just 2 per century here. So where we stand right now, it's been a volatile year, challenging year. The most markets, small cap, mid cap, international markets, all of that really recovered and rebounded for the first 6 months of 2023. But the second 6 months, or the second half of the year, it's been a completely different story. Most indices have given up all of their gains for the year. And as you can see from what we're talking about, the S&P 500 large cap stocks, while they've done the best, they have also entered correction as of the end of October. Last thing that I'd point out here for perspective, and this is my favorite chart, one of my favorite investing charts, again, just to provide some perspective that volatility does happen. And that's a feature of being a long-term investor. And that is, on average, now this just looks at the stock market since 1980. So 43 years represented here. You can see the bar chart here showing each year the S&P 500, what was the return for that year. So for the calendar year, how did the year finish? What was the result? But that red dot for each of those years is from a high point that year to a low point that year. How much decline did we see? What was the intra-year decline? And even though the previous numbers were going back to the Great Depression, this shows even in the past 43 years, on average, each year, you should expect from a high point to a low point, the market to decline almost 14%. So this suggests that you're going to see a correction just about every single year, and yet still, 32 out of 43 of those years, the market finished positive. So the main point, guys, we don't know the future here. We don't know, with how aggressive the Fed has been and with what's going on, the challenges in Russia, Ukraine, and in the Middle East, all of that sort of stuff. And we've got an election upcoming next year. And there's plenty that is creating a dark cloud over the markets, and potentially Wall Street could push things even further. However, the volatility that we've seen is normal. It is well within the kind of historical norms, and a correction does happen fairly frequently. Therefore, as a long-term investor, I would encourage you to stay focused on the long term. You get to choose. Are you going to focus on the daily movement or on the long term, the decade movement? I would have you lift your eyes up to the horizon and focus more on that long-term picture, as opposed to being swept away with your emotions in the short term. That's the first thing. Second, I'd make sure that you have diversifying strategies, not just diversifying investments, but diversifying strategies as well, to ensure that not all of your eggs are in the same basket, if you will. And while most financial advisors recommend diversifying your investments, we specialize and work with folks to make sure they have diversified strategies as well. Times when those different diversified investments or asset classes, they can all move in the same direction at the same time. We're sort of seeing that right now with all U.S. large, mid, small stocks and international stocks moving down, as well as bonds moving down as well. So having diversified strategies, make sure that you've got those that incorporated in your investment portfolio as well. And then finally, if you are nearing the time when you're going to need to start pulling dollars out, so you're nearing retirement, make sure that that is infused in your overall investment strategy as well. Invest based on your time horizon, and do so in a diversified way, long-term way, and so on. Dollars that you need in the short term, that you might need in the next couple of years, 3-4 years, to withdraw for retirement purposes, those should be positioned short-term, not long-term. Work with your certified financial planner on all that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.